Hello everyone, welcome back to my channel. You are watching Wealthy Brains and now let's get in this video. Steve H. Hanke is a professor of applied economics and founder and coordinator of the Institute for Applied Economics, Global Health, and the Study of Business Enterprise at Johns Hopkins University in Baltimore. He is a director of the Troubled Currencies Project at the Cato Institute and a senior fellow at Cato Center for Monetary and Financial Alternatives. Hanke is a well-known currency and commodity trader. Currently, he serves as chairman of the Supervisory Board of Advanced Metallurgical Group NV in Amsterdam and chairman emeritus of the Freiburg Mercantile Group Inc. Hanke is also a senior advisor at the Renmin University of China's International Monetary Research Institute and Beijing, a special counselor to the Center for Financial Stability in New York, a contributing editor at Central Banking in London, and contributor at National Review. Hanke is also a member of the Chartered Council of the Society for Economic Measurement and the Euromoney Country Risks Experts Panel. In 2020, Hanke was named a Knight of the Order of the Flag by Albanian President Ilir Meta. The advent of global monetary expansion, also known as the quantitative easing, in response to the coronavirus pandemic over the past year has been staggering. Strict lockdown measures left many businesses tapping up their capital buffers as cash, rich oil majors, and banks forfeited dividends for the first time in years. According to a linked dividend report seen by Morningstar, income payouts fell 44% last year compared to 2019. Many companies were faced with the hardships that prompted central banks around the globe to step in and prop up markets. The U.S. Federal Reserve injected $2 trillion in the form of a stimulus package in March of 2020 and a further $900 billion at the end of December, the highest surge in monetary expansion in the country for 150 years, according to the Financial Times. The copious amounts of money being printed have pushed the Fed's assets to about $7 trillion, estimated George Selgin, director of the Cato Institute Center for Monetary and Financial Alternatives, in a paper published by Wiley. Many economists are increasingly raising concerns about a serious outbreak of inflation. Steve Hanke believes that there are early indications that inflation is already occurring. We're seeing it already in commodity markets. The most sensitive prices are always raw materials down at the very start of the supply chain, and we're seeing a big uptick in commodity prices. Steel prices in the US are at high records. Soybeans are at a record high. Corn is at a record high. All the commodities are coming off the lows, he told Opto Sessions. For commodities in general, I think we're actually entering something of a super cycle. The rest will not be far behind. So by the second half of the year, we might be talking much more about inflation than we are right now. As news circulated that Congress was considering a further $1.9 trillion in stimulus, Jerome Powell, chairman of the U.S. Federal Reserve, decided to keep interest rates unchanged following a Federal Open Market Committee meeting at the end of January. The committee had said it would seek to keep inflation at the rate of 2% over the long term while maintaining monetary support. Janet Yellen, who was appointed as the U.S. Secretary of the Treasury Department in January, has also indicated that the department would back more stimulus. According to the Center for Financial Stability's monetary aggregate, Divizia M4 broad money has realized a growth rate of 28.9% as the end of December 2020. With that kind of juice going into the system, inflation is coming right around the corner, and when the inflation kicks in, and interest rates will go up because interest rates follow inflation, at the point the bull will end on the stock market, Hanke continues. But we're not there yet. Hitting the panic button. Hanke wasn't the only economic expert to have raised his concerns about inflation. Jeremy Siegel, a professor of finance at the University of Pennsylvania, raised the point that unlike in 2008, today's stimulus checks are going to private individuals and firms. I certainly do not expect hyperinflation or even high single-digit inflation, but I do believe that inflation will run well above the Fed's 2% target and will do so for several years. It is inevitable that bond rates will rise and rise far more than now envisioned by the Fed and most forecasters, he wrote in an article published by the Financial Times. As it stands, the market is seeing a large number and a large amount of stimulus Monetization of that stimulus brought money growth, a huge amount of liquidity in the systems, and very low interest rates, which is keeping the bull market going, according to Hanke. With low interest rates, you get high multiples on stocks, he notes. But once inflation starts reaching around 3.5% or 4%, which I think it will fairly soon, we will see the Fed probably start letting their foot off the accelerator, maybe even tapping on the brakes a little bit. At that point, interest rates will have gone up and the multiples will start coming down. He explains that it eventually will end because the Fed simply won't put up with inflation that is over 4 or 5%. Then they'll start hitting the panic button. In Hanke's opinion, the stock market is fine for the moment, but believes that in the meantime there'll be a number of these anti-supply side, re-regulate the economy, increase taxes movements going forward from the Joe Biden administration. Hanke suggests that there will be many negative supply side effects and aspects ahead, followed by a closing of the monetary spigot. Disclaimer: past performance is not a reliable indicator of future results. CMC Markets is an execution-only service provider. The material is for general information purposes only and does not take into account your personal circumstances or objectives. Nothing in this material is financial, investment, or other advice on which reliance should be placed. No opinion given in the material constitutes a recommendation by CMC Markets or the author that any particular investment, security, transaction, or investment strategy is suitable for any specific person. The material has not been prepared in accordance with legal requirements designed to promote the independence of investment research. Although we are not specifically prevented from dealing before providing this material, we do not seek to take advantage of the material prior to its dissemination. CMC Markets does not endorse or offer opinion on the trading strategies used by the author. Their trading strategies do not guarantee any return, and CMC Markets shall not be held responsible for any loss that you may incur, either directly or indirectly, arising from any investment based on the information contained herein. All the gold bugs in the world said that the Fed was exploding its balance sheet. The narrow measures of money was going up very fast. We're going to have hyperinflation. No, we didn't have hyperinflation because the Fed is a very small part of the broad money picture. And broad money never grew very fast. It never grew more than 5% per annum, Hanke told Kitco News. The definition of hyperinflation is a higher than 50% inflation rate on a monthly basis for more than 30 days in a row, Hanke said. He noted that there currently is still insufficient money supply growth to push inflation to those levels. Money supply properly measured through M4 is growing at 29.5% year over year. That's the highest rate we've ever had in recent history in the United States, he said. But that's not even close to the amount of money explosion you would need to have hyperinflation. Should the Fed continue the same pace of monetary stimulus as this year, inflation will come and at a higher rate than the central bank would like. Since the end of February, the Fed has jacked things up so much that there has been a big bulge in the money supply in the United States, and that will eventually feed through to higher inflation rates. So the idea that we're going to have no inflation, I don't think is correct. We're going to have more inflation, and in fact, when that inflation reaches 3.5% or 4%, I think the Fed will get pretty nervous, he said. That is all for today, folks. If you enjoyed the video, then leave a like, and if you are new, then do not forget to subscribe. See you till the next video. Thank you for watching.